Good afternoon, and thanks for joining us today as the Nationwide Marketing Group presents Independent Insights, an in-depth look at HR 6201 and the CARES Act. Of course, we had some technical difficulties today about an hour into the webinar. If you'd like to pick up where we left off, you can simply jump in this video to the time code shown here on the screen, and it'll take you right to the content as we left the call. We'll also answer many of your most frequently asked questions, and we hope that you find that content very valuable. Again, we thank you for taking the time to join us, and we hope that this webinar did bring value to your business. We look forward to seeing you as we continue this series. Take care of your team, your family, and yourself. And if you need anything at all, please don't hesitate to reach out to your Nationwide team. We stand ready to assist. Have a great day, and thank you.
Good afternoon. Tom Hickman here with Nationwide Marketing Group, and I'd like to welcome each of you as Nationwide presents the Independent Insights on HR 6201 and the CARES Act. Today's webinar has been prepared by the firm of Costangi, Brooks, Smith & Profit, and we thank them very much for taking the time. Today's content was created to help Nationwide members and really any independent dealer understand what these important recently passed laws mean for their business, and then of course to answer some frequently asked questions about the stimulus program. This webinar is just one part of the suite of member support tools, insights, and resources developed to help you best navigate the COVID-19 outbreak and the resulting impact on your business. In addition to this webinar series, you have access to best practices, consumer messaging assets, unprecedented peer-to-peer insights, government advocacy paperwork, and much, much more. Be sure if you're a member to visit MemberNet, or if you're not, our public site, nationwidegroup.org, where you'll find all of our COVID-19 resource pages. These pages are growing daily and can be a powerful resource of information for you and your business. Please do check back often, as the information does change quite often. I also do want to tell you that you have the entire Nationwide team here supporting you. This is no doubt an unprecedented situation and has disrupted your business, and that will take all of us working together to emerge on the other side of this better, smarter, and stronger businesses. However, I do want to share with you that we do know, and I know you've heard it before, that this crisis will end. There are brighter days ahead for us as retailers and for the industry and for the country. And I also want you to know that everyone here at Nationwide is working hard not only to support you through this unprecedented time, but to be ahead of the curve with information like you're going to hear today to help you not only survive, but thrive. So thank you again for being here today. Now, before we get started, I'm going to turn it over to Mike Whitaker to share a little bit more about how this webinar is going to unfold, and then we'll turn it over to Jill and Tim, our experts, to help lead the webinar. Thank you very much.
Thanks, Tom. And again, on behalf of the Nationwide Marketing Group, thank you for joining us today. In order for our experts to be able to cover all the great content they've prepared, all attendees are on mute. However, we do welcome your questions. Please feel free to use the question submission button as the webinar proceeds, and I'll ask the most frequently posted of those to our presenters at the conclusion of today's webinars. In the interest of the wide and diverse audience, including right now more than 650 dealers on today's call, please try to keep your questions focused on national programs so all in attendance can benefit. We'll make the recording of today's presentation, along with the slides that you'll see, available once the call completes. Now, it's my pleasure to introduce today's presenters. Timothy A. Davis and Jill Stricklin are partners in the renowned firm of Costangi, Brooks, Smith & Profit. Jill is based in Winston-Salem, North Carolina, and Timothy practices from Kansas City, Missouri. We're grateful to have these highly qualified experts here to share more with you today, and I'm very pleased to turn things over to Jill Stricklin.
Thank you, and thank all of you for joining us here today. Tim and I are very pleased to be here. We've got a packed agenda, as I'm sure you've seen in the news and other bulletins that you've received, including all the great resources from Nationwide Marketing Group. It's been a very busy time period in terms of new legislation and new guidance that we've received from federal agencies. And we're here today to cover where we are now in terms of the recently passed stimulus package, the CARES Act, which passed through Congress on Friday after a hotly debated week. We'll follow up on the Families First Coronavirus Response Act, or I'll call it Families First because that's a little quicker and easier to say. We've got some updates since this law was first passed. The Department of Labor and other agencies have issued some updated guidance for employers in terms of providing the paid sick leave and the expanded family and medical leave under this act. And Congress has also weighed in with a couple of additional clarifications and pieces of information clarifying this act. And then also we'll cover some practical workforce planning. As you will see, and as you can imagine, there's no one-size-fits-all solution for any of this. All of these new laws and the new provisions of the CARES Act stimulus package provide some great resources for you to use to retain your workforces, or if you're in a situation where you need to let some of your staff go, make sure that your employees are taken care of through expanded unemployment insurance. But there's no one size fits all, and what you determine is right for your business will depend on your financial circumstances, of course, any limitations on your operations that are imposed by this pandemic and COVID-19 related emergencies, and whether you have any ongoing staffing needs. So we will cover all of these options with you today. We have much more information for you than we did when the Families First Act was first enacted. But there are still some open questions, and especially with this most recent legislation, the CARES Act package, we're awaiting on certain important provisions more guidance from our federal agencies about how these various plans will be enacted, how they will actually come into play, and how you'll be able to take advantage of them. So as always, the Nationwide Marketing Group's resource page will provide you with information as soon as it becomes available and push that information out to you so that you've got the resources that you need to take advantage of these great new stimulus packages. Well, first let's catch up on what's been happening since last week. Just in the last week in terms of the COVID-19 pandemic. We've now had the social distancing recommendations and guidance extended through the end of April. We have more and more locales that are subject to shelter in place or stay at home orders, with exceptions made for what is deemed as an essential business. We're seeing increased diagnoses of COVID-19, more and more individuals being subject to isolation or quarantine, more and more shutdowns of schools and childcare centers that impact our employees who care for school-age children. We're seeing a market increase, an unprecedented increase in unemployment claims related to COVID-19 slowdowns or shutdowns, and that's been nationwide. And we're also preparing for the paid sick leave and expanded family and medical leave provisions of the Families First legislation, and that takes effect for leave taken after tomorrow, April 1st. So that's right upon us. And now we have the new CARES Act that was enacted last Friday, March 27th. So it's been a busy time. If you've had a chance to look at any of the news about the CARES Act, it might strike you that there are some apparently very different incentives that are offered by the main provisions of the CARES Act. Now, I'll first say that the CARES Act is a very big, broad piece of legislation. It's 880 pages long. It covers a wide variety of different circumstances and stimulus packages. What we're going to focus on today are the provisions of the CARES Act that pertain to businesses with fewer than 500 employees, and specifically those provisions that relate to your payroll, maintaining your payroll or taking care of your staff, making sure that they're taken care of and have what expanded unemployment insurance benefits might be available for them. So we've really narrowed it down to the Payroll Protection Program, the Emergency EIDL or disaster grants, enhanced unemployment benefits, and certain provisions for payroll tax credits and deferral under the CARES Act. And as we go through this, it might strike you that this seems to be an act with a little bit of a split personality or a push-me, pull-me type of a situation. You'll see that the Paycheck Protection Program is geared toward maintaining our workforce, keeping people at work, supporting our small businesses so that we can keep people coming to work, keep people's payroll rolling. But then the enhanced unemployment benefits, and when we get to those, you'll see that they are substantially enhanced, appear to encourage employers to let people off of their payrolls and collect these enhanced benefits. What we have is a real safety net in the enhanced unemployment benefits. And instead of thinking of this as two different types of incentives for businesses, one being maintain your payroll, keep your employees working, and the other being put them out so that they can get unemployment under this enhanced program, the way I've chosen to look at this is that it really provides us with a whole menu of opportunities, right? We're all in different circumstances with our business. We all have different staffing needs. And if you have a need for your staff, if you need your workforce, either some of your workforce or all of your workforce, to keep you operating through this time, some of the provisions like the Paycheck Protection Program and the emergency EIDL grants are going to provide some great help for you in that process. The payroll tax credits and deferral also potentially. But if you're in a situation where you simply need to let people go, you don't have the work for them, and there's no need to keep them attached on your payroll, these enhanced unemployment benefits are really going to come into play. Under the Paycheck Protection Program, and we'll go over this in detail, these are small business association loans, and they're designed to cover the payroll and other designated operating expenses for essentially a 2-month period. And these loans are potentially forgivable, at least in part, with certain incentives for keeping workers on the payroll. The enhanced unemployment benefits are increased benefits and expanded entitlement periods to those who are eligible for unemployment under state law. And these benefits are even on some occasions expanded to those who are not traditionally eligible for unemployment benefits under state law, such as people who are self-employed, independent contractors, individuals who have a limited work history or perhaps have insufficient earnings during their base salary period, and others. So these are big expansions, big changes, and we'll just dive in and start with the Paycheck Protection Program. This is a part of the CARES Act that amends Section 7A of the Small Business Act to provide 100% federally guaranteed loans to help businesses or entities with fewer than 500 employees, and also certain sole proprietors, independent contractors, and self-employed individuals get through this crisis. It applies to loans that cover the period of February 15, 2020 through June 30, 2020, and it's available to entities with fewer than 500 employees. There are some special provisions for those in the hospitality industries. For the food service and accommodation industry, the 500 or fewer employees is applied per physical location, as opposed to the entire business, the way it's applied to people in other industries. And for those who are operating as a franchise or who receive financial assistance through the SBIC, the normal affiliation rules do not apply. In other words, those rules are loosened up so those entities who are operating as a franchise who are receiving SBIC assistance can obtain loans through this program. The loans are made both by the Small Business Association and also by authorized commercial lenders, and certain procedural requirements that normally would apply to SBA loans are loosened or waived here. For example, ordinarily to receive a Section 7A loan under the Small Business Act, a borrower would need to show that there was no credit available to them elsewhere or provide a personal guarantee or collateral. And those requirements are all waived for these emergency loans. The administrative fees are also waived. Now, this is in part designed to make these loans easier for people to get. It's also in part designed to expedite the process of obtaining these loans so that people can obtain the loans more quickly. Even with these expedited process, my understanding is that the SBA is anticipating a huge volume of loan applications. So there's really no guarantee, if you will. The SBA hasn't indicated how long they think it will take to turn these applications around. We'll talk through the details of these loans, but I encourage you, if after today's call or maybe even before today's call, you've determined that the PPP loan, as I'll call them, the Payroll Protection Program loan, is something that you'd like to apply for, I'd encourage you, if you haven't already done so, to reach out to your lender or other lenders in your community, see if they're authorized by the SBA to provide these loans, and get your name in the queue, so that when all of the forms and the guidelines come out from the Small Business Administration, and they haven't yet, you'll be in line and ready. And you could also get started on pulling together some of the information and documentation that you'll need in order to apply for these loans, and we'll talk through what that might be. The maximum loan amount. There's a lot of math involved with PPP loans, you'll see. Here, the maximum loan amount is the lesser of 2.5 times the average total monthly payroll costs, and that average is determined over the 1-year period before the loan origination for a cap of $10 million. There are some alternative computation methods provided in the statute for entities who are not in business in 2019, and also for seasonal employers. And there's also a provision that allows, in addition to this maximum loan amount, the amount of the outstanding balance on any existing Section 7B2 disaster relief loans that have been made after January 31st, 2020, to be refinanced as a part of a covered loan under this program. Payroll costs, and these are the payroll costs that are used to determine the maximum loan amount, are defined very broadly. When you're looking to find out what you might be entitled to under this PPP loan program, you should consider salary, wages, commissions, and other similar compensation, payment of cash tips or equivalents, payments made for vacation, parental, family, and medical leave or sick leave, allowances for dismissal or separation. So if there's any severance benefits that you've paid out for people who have been terminated or separated from their employment, payments made for group health insurance, including those premiums, payment of retirement benefits, and also certain state or local taxes that are assessed on the earnings. So your maximum loan amount will be basically 2.5 times the average monthly payroll cost using that broad definition, and the average being over the 1-year period prior to the loan origination. The payroll costs do exclude the compensation of any individual employee in excess of an annual salary of $100,000. Now, there are two different ways to read this, and we'll need some additional guidance on this from the administrative agencies. One is that the entire salary of an individual employee who earns more than $100,000 a year should be excluded. And then the other is that the amount of any individual employee's salary that exceeds an annual salary of $100,000 should be excluded. I believe it's more likely to be the latter. In other words, I think you can include the first $100,000 of the individual's salary in your computation of payroll costs and exclude the excess, any amount over $100,000, but we'll need to receive some additional guidance for that to be clarified for us. Any taxes imposed or withheld from those payroll amounts as income taxes, and there's some other categories of taxes that can be excluded or should be excluded from payroll costs. Compensation of any employee who resides outside of the U.S., and also any payments for qualified sick leave or family and medical leave for which credits are allowed under the Families First Act are excluded from payroll costs, basically to prevent you from double dipping. When borrowers submit an application for a PPP loan, the lenders will consider whether the applicant was in business, was in operation on February 15, 2020, and whether the borrower had employees for whom it paid salaries and payroll taxes or paid independent contractors as reported on Form 1099. In order to receive a loan, the borrower has to certify that the loan request is necessary to support ongoing operations due to the uncertainty of current economic conditions. Frankly, I'm not sure I know of any, well, I won't say that. There are very few business that I know of who aren't facing this type of uncertainty of current economic conditions right now. But the second certification is that the funds will be used to retain workers and maintain payroll or to make mortgage payments, lease payments, and utility payments. and that you don't have a duplicative Section A loan application pending. And during the period of February 15, 2020 through the end of this year, December 31st, 2020, the borrower has not received funds under Section 7A that's for the same purpose. In addition to the allowable uses of a Section 7A loan, borrowers under the PPP, the Paycheck Protection Program, may use the loan proceeds for the following items: payroll costs, costs related to the continuation of group health care during periods of paid sick, medical, or family and medical leave, and insurance premiums. Employee salaries, commissions, or similar compensations. I know that seems duplicative of payroll costs, and it probably is, but the statute lists them out this way as separate items. Interest payments on mortgage obligations, rent, including rent under a lease agreement, utilities, and interest on debt obligations that were incurred before February 15 of 2020. So you've got a pretty good list of allowable uses for the covered time period, which is February 15, 2020 through June 30 of 2020. There's also a fantastic provision on these loans for loan forgiveness, and this is all about keeping people or bringing people back onto the payroll. A borrower is eligible for loan forgiveness on the amount that's spent during the 8-week period after the loan originates on payroll costs, payment of interest on mortgage obligations, as long as the mortgage was incurred before February 15, 2020 in the ordinary course of business. I guess you can't go out and get a new mortgage and try to use this loan to pay interest on that. Payment on rent obligations based on a lease that was in effect before February 15th. Covered utility payments, and that's defined to include your electricity, gas, water, transportation, telephone, or internet access for which the service already began before February 15th, and additional wages paid to tipped employees. The total amount of the loan forgiveness cannot exceed the principal, and if this amount is forgiven, loan forgiveness under this section means that it's considered a canceled indebtedness for purposes of taxes and other purposes. So if during the 8-week period after your loan originates, you spend the loan proceeds on these categories of payments, that total amount will be forgiven. You don't have to pay it back. It's essentially a grant, right? Required documentation. If a borrower is going to seek loan forgiveness for a PPP loan, documentation that must be submitted to your lender includes documentation verifying the amount of full-time equivalent employees on the payroll and pay rates for the relevant time periods, and that includes payroll tax filings that are reported to the IRS, as well as state income, payroll, and unemployment insurance filings. Also documentation including canceled checks, payment receipts, transcripts of accounts, or other documents regarding payments on covered mortgage obligations, lease obligations, and covered utilities. There is the potential for this loan forgiveness amount to be reduced, and this is all based on your payroll and the status of your workforce. The loan forgiveness amount will be reduced if the borrower reduces the number of full-time equivalent employees or reduces the amount of the salary and wages paid to those employees by more than 25% compared with February 15, 2020. And there's more math involved here. In order to determine the amount of the reduction, you would multiply the amount of the loan forgiveness, and that's the allowable cost for loan forgiveness that we just reviewed over the 8-week period after your loan originated. And then you would multiply that amount, the loan forgiveness amount, by the quotient obtained from dividing the average number of full-time equivalent employees per month during that same 8-week period after the loan originated by one of two things. At the borrower's election, your choice, you can multiply that, you can divide that by the average number of FTE employees per month from February 15, 2019 to June 30, 2019, or the average number of FTEs per month from January 1st, 2020 till February 29th, 2020. The SBA will deduct the amount of any reduction in total salaries and wages of any employee during the 8 weeks after the loan originated that exceeds 25% of the total salary and wages of the employee during the most recent full quarter during which the employee was employed before the 8-week period began. And remember, that 8-week period is after a loan originated. So just in summary, if you reduce during the 8-week period after you receive this loan, if you reduce either the number of your FTE employees or you reduce the salary and wages paid to all employees by more than 25%, the amount of loan forgiveness that you're eligible to receive will be decreased proportionately, and you'll need to pay that back. There is a provision that allows a little bit of grace. There's somewhat of a grace period here allowed for rehires or reinstatement of pay if you've recently furloughed or laid off some of your workers due to the economic downturn or reduce their pay, and you eliminate those conditions in time. The amount of loan forgiveness is determined without regard to any reduction in FTE employees or reduction in salary or wages for the period of February 15, 2020 until 30 days after the CARES Act was enacted, which brings us to April 26, 2020. The CARES Act was enacted on March 27th. If not later than June 30th, the borrower has eliminated the reduction in employees or salary or wages. So if you've already reduced your workforce in terms of the number of FTE employees or reduced the salary or wages paid to all of your employees after February 15th, or if you haven't already done so, if you have to have such reductions before April 26, 2020, you will not be penalized. Your loan forgiveness amount will not be reduced as long as before June 30, 2020, you eliminate that reduction. You bring the people back on the payroll, get them back to work, or you bring their salary and wages back to their February 15, 2020 amount. So to maximize loan forgiveness, think of it this way. Any temporary reductions in your workforce or reductions in salary and wages that you think in your business you might need should be conducted by April 26, 2020. And that way, if you're able to bring them back before June 30th, those reductions will not count against you at all. To the extent possible, and if you need them, if you need your employees back at work for staffing, the employees should be reinstated and their salary and wages should be restored first during the 8 weeks after a loan originated, and that will increase the forgivable amount of your loan just by increasing your payroll costs. Or if you can't do that, by June 30th, 2020, and that will avoid, if you're able to bring them back or bring their salaries back to their February 15th rates, that'll avoid a reduction in loan forgiveness. Again, though, I can't stress enough that this is all driven. Everything we're discussing today is going to be driven by your staffing needs. If you're shut down right now because of a shelter-in-place order and your business is not considered an essential business, you can't work, you don't have any need to have employees, for example, we're not advocating that you bring them back on payroll just to do nothing. But if you've got a need for your workers and you're able to either keep them on the payroll, or if you need to let them go, bring them back within these time periods, that'll help you maximize the loan forgiveness provisions of the PPP, which can be considerable. The remaining balance of these PPP loans after loan forgiveness, first of all, it's guaranteed by the Small Business Administration. These loans have a maximum maturity of 10 years from the application for loan forgiveness. The interest rate is not to exceed 4%. And this next provision, I think, is key in a lot of respects. Payment of principal, interest, and fees is deferred for a period of 6 months to 1 year. I think this is so important because we're all living in a time of real uncertainty now, and even more so than usual, it's difficult to plan what our payroll needs, what our staffing needs are going to be, what our expenses are going to be. So if you go into this thinking that you're going to be able to maintain your payroll, maintain your workforce, and have a considerable amount of loan forgiveness available to you, and then business circumstances do not allow you to do that, you're able to, the payment of the principal, interest, and fees is deferred. So you're able to hold that amount that might otherwise be forgiven if you maintained your payroll, basically in trust or and hold it aside so that if you need to pay that amount back, you can. It's a little bit of a security blanket there, and there'll be no interest, fees, or penalties incurred for 6 months to a year while you see how that plays out. There's also no prepayment penalty. So if you see, boy, I'm not going to be eligible for the amount of loan forgiveness, or my loan forgiveness is going to be reduced based on my payroll maintenance, and I didn't foresee that, you can always just go ahead and prepay that amount without penalty. SBA guidance will be coming out soon, very soon, we hope. According to the CARES Act, the guidance is due 15 days after the enactment of the law. The SBA's website, and we've got it here, www.sba.gov, has a great resource center dealing with COVID-19. And you'll see if you go there that for the PPP loan section, there's not much available yet. They haven't come out with the forms. They haven't come out with a guidance. They're not ready to accept applications for those loans yet, and neither are their lenders. But we're hoping that soon they'll have that remedied, and certainly they'll have some guidance within 15 days after enactment, which enactment, again, was March 27th. So the 15-day period's already running. There's another provision in the same section of the CARES Act for emergency injury disaster loans that are available due to the COVID-19 pandemic, and they are also available under looser terms. And there's a really great cash infusion option available here for people who apply for these EIDL grants under the CARES Act. This is another SBA loan, and basically what the CARES Act has done is expanded the SBA Emergency Injury Disaster Loan Program to be available to businesses with not more than 500 employees for the period of January 31st of this year all the way through December 31st. Basically, for EIDLs that are in response to COVID-19 during that covered period, the SBA's normal rules are waived regarding personal guarantees on loans below $200,000, the requirement of being in business for 1 year that would typically apply, as long as you were in operation on January 31st, 2020, and also the normal requirement that the borrower was not able to obtain credit elsewhere. And these loans, again, we've got some expedited, loosened procedures here. These loans are to be approved by the SBA based solely on an applicant's credit score, or the SBA can determine an alternate method for determining the applicant's ability to repay the loan. These are loans that will be available through the SBA, not through commercial lenders. And here's the immediate cash influx. Borrowers may request an emergency advance on these EIDL loans, and this is the grant part of this here, up to $10,000, payable by the Small Business Association within 3 days after submitting the application. That advance may be used for allowable purposes under Section 7B2 of the SBA, including the ones listed here: providing paid sick leave to employees who are unable to work due to COVID-19, maintaining payroll to retain employees during business disruptions or substantial slowdowns, meeting increased costs to obtain materials that might be unavailable because you've had interruptions in your normal supply chains, making rent or mortgage payments, and repaying obligations on other debts that can't be met due to revenue losses. If the borrower uses the funds, the advanced funds up to $10,000 for those purposes, they will not be required to repay any amount of the advance, even if the 7B2 loan is subsequently denied. And if an applicant receives an advance and is approved also for a PPP loan, because you can do both, the amount of any advance up to $10,000 that's received will be reduced from the forgivable loan amount. So this is a great program. I think it's going to be helpful in terms of immediate cash available to people. And one more point before we move on. This is something that the SBA already has available and ready to roll. If you go to www.sba.gov, the SBA already has an application form where borrowers can certify that they are able to and authorized to apply and confirm that all the information that is provided is accurate. And so you can go ahead and complete those emergency EIDL applications online now. The beginning of the application form indicates that the entire form should take just a little over 2 hours to complete. So it doesn't sound like it's a particularly onerous process. There also have been, as I mentioned before, some pretty significant expansions of unemployment. These expansions began with the Families First Act. The Families First Act amended Social Security Act to allow states greater access to emergency funds for unemployment insurance for people who lose their jobs or have their hours reduced due to COVID-19. And there's also significant funding from the federal government to states to help the states with the administration of these unemployment claims and the huge increase that we've seen. Also, the Families First law required states to amend the unemployment rules to allow greater access and hasten payment of unemployment benefits. And the states really responded to this. You'll see around the country that most states have now waived the 7-day waiting period that's typically required before people can begin receiving unemployment benefits, eliminated job search requirements. Many states have also entered or implemented new requirements that require or encourage employers to file partial claims for partial unemployment on behalf of their employees. And those are situations where somebody's hours have been reduced by a specified amount. In many states, it's around the 50 to 60% neighborhood. If someone's only earning 50 to 60% of their regular wages, employers may file what are known as attached claims on behalf of employees who are still attached to their payroll. So check the state laws where you're doing business. These unemployment laws vary a great deal state by state, and even with the CARES Act amendments that we'll cover in a minute, the provisions of your state law are still going to be significant of determining how much somebody is going to be eligible, whether somebody's eligible, and how much they're going to be eligible to receive under state law before the CARES Act supplements kick in. The CARES Act was described by some of our legislators while the law was going through Congress as basically unemployment on steroids, and I don't disagree with that. There are a number of provisions here. One is an emergency increase in unemployment compensation benefits. Basically, people who are already entitled to receive regular unemployment benefits under state law get a bump of an additional $600 a week for essentially the first 4 months or through July 31st, 2020. And that is considerable. Here in North Carolina, where I practice, our unemployment benefits available per week for someone who's totally unemployed is capped at $350. So that gives you a pretty good sense of how considerable the $600 bump is for people. And it's true that in many cases, in some cases, people might be earning as much, if not more, under these enhanced benefits than they might have earned while they were working, which I guess provides an economic stimulus of another type, in addition to just covering people's regular wages. There's also a pandemic emergency unemployment compensation system set up to extend the time period during which people who are entitled to receive benefits under state law may receive them for an additional 13 weeks. So if someone is collecting unemployment insurance under state law and they've exhausted the amount that they're entitled to receive, and usually with extensions in most states, that's 26 weeks, there's an additional 13 weeks of benefits available if they satisfy certain requirements that they're available to work, looking for work, etc. And the Act encourages the state unemployment agencies to view the requirements of looking for work and available to work a little bit more leniently in response to the business environment created by the pandemic. So there's a total of 39 weeks if your state is one in which 26 weeks is the maximum available. There's also been a pandemic employment assistance program provided to people who are not otherwise typically eligible for unemployment benefits, and that includes gig workers, people who are self-employed, or people who had insufficient earnings or an insufficient work history to qualify under state law, and that's also capped at 39 weeks. I'd like to talk a little bit about the payroll tax credits of the CARES Act, because this could also be something that might be beneficial to many of you on the call. There is
Jill,
yes.
This is Tim. Could I briefly interject on that prior slide, if you could go back to that one?
Oh, second? Absolutely.
And the pointer I'd make there is this slide in particular offers many people on this call an opportunity to be creative. I work with several retail restaurant in the Kansas City, Missouri area, and they've got a situation where they've got full-time people that are on their payroll, and they got a lot of part-time, obviously. It's a restaurant. They supplement that way. As part of this deal, restaurants have been brutalized where they're letting people go. So they've actually approached different people and said, look, you don't work enough hours. You're not going to qualify for unemployment under state law, which then means you do not get your $600 enhancement on top of it. So they've coordinated who they might lay off if people wanted to go if they were full-time, so that they could be furloughed or laid off, get their maximum under the state law, in this case Missouri's $320, plus their $600, which moves them to $920, and those full-time people are not impacted negatively in any way with the layoff, whereas if they laid off the part-time people who were not covered and hadn't contributed enough to get any unemployment under the state law and thus could not get the $600 bump on top of it, to where they're actually laying off more of their full-time people and keeping their part-time to maximize the economic situation of their employees and reduce the hardship by utilizing the $600 bump. So that's the only point I wanted to make there. Is a lot of the people on this call, I think, might have a full-time, part-time situation where they might be able to do it in a way that maximizes the benefit to their employees. Sorry for interjecting. I thought that'd be the point to make there, though. Thanks.
Oh, yes. Thank you. I think that's great. And that's just another example of how there's really no one-size-fits-all approach, and how many tools the stimulus package really has provided for employers to look at your business situation, look at your workforce, and make the decisions that are going to make the most sense for the company and also for your employees. The payroll tax credits. Basically, the CARES Act provides for a refundable payroll tax credit of 50% of the wages, up to $10,000 per employee, paid during each calendar quarter during the COVID-19 crisis. There's some exclusions here for paid sick and family and medical leave under the Families First Act, because remember, and Tim's going to give you some updates on Family First, but remember that you already get a payroll tax credit for the amount that's paid to your employees for the sick and family and medical leave under Families First. So this prevents you from double dipping again. It does include qualified health plan expenses. And this is available to businesses whose operations either were fully or partially suspended due to orders from a governmental authority limiting commerce, travel, or group meetings as a result of COVID-19, or whose receipts declined by more than 50% when compared to the same quarter in 2019. And there's some different ways of computing this depending on the size of the employer. For those of you on the call with 100 or fewer full-time employees, it covers wages paid to all employees during any quarter or applicable quarter in which there was a COVID-19 impact, one of the two that we've described above here. If you've got more than 100 full-time employees, it only covers the wages for employees who are not providing services during that time period due to the COVID-19 impact. So if you've got more than 100 full-time employees and you've furloughed or laid off some of your people, but you've got some of your people working at home, for example, and teleworking, it's only going to cover the wages for the people who are not providing services. This payroll tax credit may not exceed applicable employment taxes in any one quarter. And if you are receiving a forgivable loan under the PPP program, you are not eligible for tax credits. This is an either-or situation. So this is one of those situations to, look at your staffing needs, look at your financial situation, and decide which of these two is going to be more beneficial for you. Either the tax credits and we'll move on to the delayed tax payment too, which is a part of that, or the potential to receive one of these forgivable loans under PPP. And then finally, the CARES Act has a provision for the delayed payment of payroll taxes. All employers and people who are self-employed may defer payment of the employer share of payroll taxes owed on wages paid for the period of beginning on the date of enactment, which again was March 27th, and ending December 31st, 2020. And basically there's a two installment system set up. 50% of those payroll taxes would be due by December 31st of 2021, and the remaining 50% due by December 31st, 2022. And this does not apply again to any taxpayer who also receives loan forgiveness on the PPP Paycheck Protection Program loan. So if you get loan forgiveness on that, you don't also get to defer or delay payment on your payroll taxes. But that is a high-level overview. And when I say high-level, I mean, 64,000 feet level overview of the various types of programs that, relate in whole or in part to your payroll, your staffing needs, and considerations for you as you're planning. We've listed here, Tim and I have listed some practical considerations for y'all to think about in terms of your planning. Y'all have probably had this in mind ever since the pandemic began, but especially now that we have more information about the options that are available to us through the stimulus package, these are some things to think through. What's the current state of your business? Are you presently operating? Do you have staffing needs now? Do you expect to continue operation given your business's needs and also any restrictions that might apply to you in terms of a shelter-at-home order or other restriction on your ability to conduct your business? Have you already laid off or terminated employees? How do you project your staffing needs in the upcoming months? And I want to stress again that your decisions, I'd encourage you to base your thinking and your decisions on these stimulus package goals on what your actual staffing needs are. There's no reason to put somebody back on payroll if you don't have the need for them to be working. There might be a better way for you to use this stimulus package and get the best benefit from it. But if you need people either working at home or teleworking or otherwise, this stimulus package provides a lot of options for you in that regard too. What's your cash flow situation? How soon do you need that cash? Can you wait and receive the benefit later through the payroll tax credit situation, for example? Can you continue to cover operating expenses while you're awaiting relief from some of these stimulus provisions? So all factors for you to consider as you're weighing your options. Keep an eye on the SBA Gov website, also the Nationwide Marketing Group resources. They'll continue to push information out as it's available for you. And with that, I'd like to turn it over to Tim. Tim, I ended up taking a little more time than I should have, sorry. But Tim will revisit the Families First Act. For those of you who joined us last week, we covered an overview of what the Families First Act required in terms of the paid sick leave and the expanded family and medical leave that would be required starting tomorrow, leave after April 1st. And we've now got a lot more guidance from some of our agencies and, in fact, from a few of the CARES Act provisions. So for those of you who anticipate having, you still got people working or you're bringing them back in the near future, these are provisions that will apply to you. So, Tim?
All right. Thank you very much, Jill, and welcome back, everybody, to the second series, or the second in a two-part or maybe even three-part series if we get more laws coming under this corona response that we're dealing with here. I'm going to start by apologizing to any of you who sent me emails after our last webinar, in that I've done about 10 webinars like this since in the last 2 weeks, and I've got over 3,000 emails from people following up as this law has been confusing. So I am slowly wading through those. At the same time, I'm trying to talk to so many clients about their compliance obligations. So I do apologize if I haven't gotten to your questions. Hopefully some of your questions have already been answered and you haven't been delayed by me, but I will do my best to get to you if I haven't, as I'm sure Jill will as well if you have additional follow-up questions on this webinar. what I want to talk about is if you look at the DOL.gov, that website that we cite there, a lot of what I'm going to be talking about are based on updates that the DOL did through a Q&A process that it did after the Families First Coronavirus Response Act. I wish I had something easy like 3 Ps like you could call yours, Jill. It would be a lot easier to do this, but there's no way to summarize the first law we're dealing with here. But the Families First Act hasn't been changed, but we're getting a lot more guidance. The Department of Labor updates that Q&A every single day almost, and I think they're up to 51 questions, some of which Jill and I are going to try and address, or we did address in this PowerPoint, other ones which if you've got questions on how a particular section might apply, take a look at that because that might answer it. I am also not going to go back and cover the basics that we covered on the last webinar. For anybody who wasn't on the one we did last week, that covers all of the basics of the Families First Act, what kind of leave is available, all of those items are on here. So I'm really just going to do an update so I'm not redundant for this group. And if you've got questions about the law in general, you can definitely go back and look at the webinar, I believe, and check that out, or get the PowerPoint from Jill and I. Obviously, we know now that this law is not retroactive, so let me start going through this slide here. It kicks in tomorrow, so any leave that you might have given paid to employees to cover the time period up until April 1st, you are not going to get reimbursed by the federal government. So that was just out of the kindness of your own hearts. I'm sure your employees appreciate it, but that is not something you're going to get covered. The other law kicks in today. Last Friday, the Department of Labor issued the poster that all of you have to have up in your workplaces detailing these new laws. You need to either put that up where you normally put your employment posters. If you've got people that are out teleworking now or otherwise working from home, you're supposed to email a copy of this poster to them so that they can know their information. That has to be up by tomorrow. Also something you can easily just download from the website. I think Nationwide might have also put that in the materials they provided, so you might want to double check that. But you need to provide that and get that out there. If we could go on to the next slide, Jill, that would be great. So here is what Jill talked about the CARES Act. The CARES Act did a little bit with the Families First Act as well, but it really is not dramatic changes that are going to impact on you. We put this in there so there's clarity on what they codified that was unclear under the Families First Act. So this slide really shows some of the kind of technical issues people had. If you had these kind of questions, you can see on this slide how it applies. But there's not a lot of detail I want to go into this slide. I want to get to the Q&As if we can.
Yeah, can I just interject real quick here?
Yes, cover that.
One thing to watch is that the CARES Act did direct the Secretary of Treasury to provide forms and instructions for calculating the advances. And these are remember you get a payroll tax credit advance for qualifying wages that are paid as either emergency paid sick leave or emergency family and medical leave. And Congress in the CARES Act directed the Secretary of the Treasury to get those forms prepared and instructions and guidance out to employers. We don't have that, but watch for that.
Yeah, that'll be another one that I think the Secretary of Treasury is supposed to issue it, but it should be available on the DOL website as well. So that DOL.gov should have all those forms and things once they start coming out, hopefully in the next few days. So some of the questions that they've got that the Department of Labor had since we updated this. How do you pay people? What is the amount that you pay somebody who goes out on a paid sick leave or the new paid family and medical leave? And the things that they're clarifying now is you pay them their regular rate of pay, and the basic way you calculate that is for somebody who doesn't just have an hourly amount, you average rate of pay for the 6 months preceding the leave. You would include things, I don't think you have tips, but you might have piece rate, and you might have commission employees. You would include those things in your calculation and then divide it out by what that really totals out to their hourly rate of pay would be, and that's what they would get if they take leave under paid sick leave or the new paid family and medical leave. That's the rate of pay that they've qualified or clarified for us. For part-time employees, there's also always coming up the question of, well, how do we determine the number of hours that a part-time person would get off under these laws? Keep in mind, if it's the paid sick leave, they get 80 hours. If it's the paid FMLA, they get the average that we're looking at here. So you look at the number of hours the employee was regularly scheduled to work. And if there's somebody who worked every week, it was 20 hours a week, then for the paid FMLA, they're going to get 12 weeks at 20 hours. Fairly easy to determine, fairly easy to then pay. If they fluctuated quite a bit, however, if their schedule was up and down, some weeks it's 10, some weeks it's 30, some weeks it's 15, you would then go back just like the compensation or the regular rate and calculate a 6-month average when you're determining how many hours somebody gets that. So those are the two ways that you're looking at it. They did clarify as well. Somebody asked the question, well, would they get paid overtime hours? And would they be able to be paid, to pay for overtime? And the answer to that is no. They get 80 hours of pay at whatever the straight rate would be if they are a full-time person, and then a lesser amount if they're a part-time person that they would get paid. You don't pay any kind of overtime premium for that. The other question that has come up a lot is, how do these two new laws interact? And in fact, there's a third question: how do these two new laws interact if you're more than 50 employees and you've got to pay the other FMLA? But the way they're doing this now, and they're making it clear that basically stacking can apply under certain circumstances, and yet it would run concurrently under others, and I'll explain that. For the 80 hours of paid sick leave, that is available for any combination of the qualifying reasons. And you'll remember there are basically 5 reasons somebody could get this 80 hours of paid sick leave. Unfortunately, if they contract COVID-19 and they've got to be out for 2 weeks to recover from that. If a family member does and they want to have to be out for 2 weeks to recover for that, and they're providing the care for the family member. There are basically 5 different reasons, and they've made it clear that you get a total of 80 hours for all of them, not just 80 hours for each, which would be truly burdensome. So on the second bullet point here, what about the one that overlaps between the two laws? You'll remember the paid sick leave laws gives you the 80 hours of paid sick time. One of the elements of that is if your child has been kicked out of school because the school closed, or out of their daycare because the daycare closed, you could use your 80 hours of paid leave for that. The paid FMLA, that's the only thing you could use paid FMLA leave for if your child has been, school's closed or your daycare's closed. So that is the one where the two of these things overlap. In that instance, when you've got the 2 weeks of paid leave, you add that to the FMLA, and between the two, you get a total of 12 weeks for those things. You don't get 2 for the first one or 80 hours for the first one, plus 12 weeks. You get a total of 12 weeks. However, if you take 2 weeks off because your child has been exited from school and you use your 80 hours for that, and then if you use, I get that backwards. If you take 80 hours off for something that is unrelated to your child exiting from school, such as if you your employee contracts coronavirus, or they're caring for somebody that does, and then they want to take also more time off because their kid is kicked out of school, those two do stack because they don't overlap. In that instance, the employee could take 14 weeks of leave, not just 12. So when we go on then to how does this work with traditional FMLA leave for any of you who have 50 more employees, the example I gave on our last webinar was I actually had a situation where a female employee of a client took 12 weeks of week when she had her baby. And now the baby is going to has already been kicked out of the daycare system because the daycare is not operating due to a quarantine and the coronavirus. She asked if she could take 12 more weeks paid now under the new law. And the answer to that is no. She could not take 12 weeks of leave because she already used her paid FMLA leave. However, she could take the 80 hours under the paid sick time law because that is a different type of leave event. So that is where the two become different that you have to look at and think about in that regard. Employee eligible for paid, okay, go ahead, Joe. Documentation. There's been a lot of questions.
Sorry.
No, that's all right. That's all right. Employers that provide paid sick leave and expanded FMLA leave are eligible for reimbursement through this tax that we're talking about here. The whole leave process was designed to be cost neutral to you so that you do not have to fund it. The federal government is funding this thing. However, if you're going to try and get that money back and you're going to keep track of all the forms, as Jill mentioned, IRS is going to have applicable forms for all of this. and you're going to want to keep pretty close track of this anyway for any kind of amount. If you're claiming a tax credit, whatever documentation you would need to get to show that you were paying it for the right circumstances. If your school closed, for example, get a document, or if they posted it on a website, print that off. Keep track of all the records that you are provided from somebody, whether it be directly from an employee who gives you a note from a doctor saying that they've got to care for somebody, or whether it be from a school or a daycare saying we are closed due to this, so that you'll be able to, if you do get any kind of audit, to demonstrate that you only had people taking leave for the appropriate circumstances and all the money the government paid you back was appropriate. You've got the appropriate kind of documentation to cover that.
And ladies and gentlemen, at this point in today's webinar, we did experience some technical difficulties with our platform. However, we have Jill Stricklin returning to go over the rest of today's content and answer your questions. So Jill, we'll go back to you.
Thank you. Glad to be back with you. We're picking up on the Department of Labor guidance under the Families First Act as to what happens when the worksite itself is closed. Are the people who don't have work available to them because the worksite is closed eligible for either the paid sick leave or expanded family and medical leave provisions of Families First? And the answer, according to the Department of Labor, is no. If an employer closes a worksite either before April 1st, when the paid leave becomes available, or after that date, and no work is available for the employee to do, so in other words, the employee can't continue to work from home or telework, that employee will not receive paid sick leave or expanded family and medical leave, but might be entitled to receive unemployment benefits depending on the what your state unemployment insurance law says. If the worksite closes while the employee is already on paid sick leave or expanded family and medical leave, that employer must pay for any leave used before the closure, but is not responsible for making ongoing payments of leave after the facility closes. And this is true regardless of whether the employer closes the worksite due to an overall lack of business or due to a federal, state, or local directive that might be, for example, a shelter-at-home order. So this is significant. Basically, if the work is not available, if you've closed the worksite, and there's no work for the person to do, that's a situation where they're potentially entitled to unemployment insurance, but not entitled to paid leave under the Families First Act. So this answered a big question on which there'd been some uncertainty and a lot of debate since the Family First Act was enacted. The Department of Labor also has weighed in with some additional guidance on group health coverage. An employer must continue group health coverage during expanded family and medical leave, but the employer can still require the employee to continue making any normal contributions to the cost of coverage, including insurance premiums, just the way they normally would have done if they had continued working. And this is consistent with the provisions of the traditional FMLA for those of you who have 50 or more employees and must comply with those provisions. While on paid sick leave, this is the 80 hours of leave, an employer must continue group health insurance coverage based on the plan language if the absence from work is due to any health factor. Plan language generally says that, and is required to say under HIPAA, that an absence from work due to any health factor is counted as being or treated as being actively at work under the plan. So again, Tim mentioned this last week for those of you who participated in the first of our sessions on this topic, but I'll mention it again. If you've got questions about whether somebody who's been laid off or is on leave or furloughed is eligible to continue receiving group health coverage if they're still attached to your payroll, contact your insurance provider and make sure you understand what the plan says. If there needs to be any modifications to the plan language to accommodate people during this really unusual pandemic situation, some of our clients have found that the insurance providers are willing to enter into a written temporary modification of the plan language to get us through this situation. So make sure you get that in writing and make sure that it is something that modifies the plan language, even if it is on a temporary basis. And remember that COBRA, which provides for the continuation of group health insurance coverage, does apply to employers with 20 or more employees. And if there's a triggering event such as separation or reduction in work hours that would result in loss of coverage, COBRA applies, and the employer is required to be sure that the employee receives that COBRA notice. And last but not least, this is something that we were all waiting for, and I understand and could understand why many of the participants on this call would be interested in knowing how this works. As you all know, the Families First Act provides for an exemption to the paid sick leave requirements or expanded family and medical leave requirements for employers with fewer than 50 employees. And the question has come up since this law was enacted. How do we go about receiving this exemption? Early on, after the law was enacted, the Department of Labor issued some guidance basically saying, don't send documentation to us about the reasons why you qualify for exemption, but be aware that you're going to have to provide some documentation about why providing the paid sick leave and paid family and medical leave would jeopardize the viability of your small business as a going concern. But don't provide that to us. Well, now the Department of Labor has provided some additional information about what the criteria are and how a small business can document this exemption. The small business can document this exemption and claim it itself. A small business may claim this exemption if an authorized officer of the business has determined that the following factors apply. And these are or factors. In other words, only one of them has to apply. The first one is the provision of paid sick leave or expanded family and medical leave would result in the small business's expenses and financial obligations exceeding available business revenue and cause a small business to cease operating at a minimal capacity. Notice that there's an or there between paid sick leave and expanded family and medical leave. You might decide that the 80 hours of paid sick leave for the limited purpose of a school or a child care closure, and your employees need to care for a child in that type of a circumstances, might be something that you can handle. We can provide paid sick leave for 80 hours, but this expanded family and medical leave for the same purpose is just too much. Remember, the paid sick leave is also available for other reasons as well. The small business could certify that the provision of the expanded family and medical leave, and that's the 12 weeks, including the 10 weeks of paid leave, would result in our expenses and financial obligations exceeding our available revenues and cause us to cease operating at a minimal capacity, even if you decide that the paid sick leave of the 80 hours is something that you can do. That's one of the criteria. Another one is the absence of the employee or employees requesting paid sick leave or expanded family and medical leave would entail a substantial risk to the financial health or operational capabilities of the small business because of the employee's specialized skills, knowledge of the business, or responsibilities. So if a small business can certify this and document this, then they're entitled to claim the exemption from the paid leave requirements. And again, it's paid sick leave or family and medical leave. So you could decide, for example, that you can afford to provide the 80 hours of paid sick leave for qualifying circumstances, but not the family and medical leave that expands to 12 weeks. And I imagine a number of you all are in this circumstance where you've got a small enough staff that just having one person out or two people out, given their specialized skills, knowledge of the business, and responsibilities, would have this kind of an impact. And then finally, the third criteria, there are not sufficient workers who are able, willing, and qualified and who will be available at the time and place needed to perform the labor or services provided by the employee or employees who are requesting paid leave or expanded family and medical leave. And these labor or services are needed for the small business to operate at a minimal capacity. Again, I could imagine that there might be a number of people on this call who might be able to certify that. The key here, there's two keys really. One is be sure you think through these criteria carefully and document. Keep the documentation, your regular business documentation, documents that you prepare in the regular course of your business that shows why you meet the exemption. And also, I would, if this were me, I would want to prepare for the signature of the authorized officer of the business a certification or a statement that explains why one or more of these criteria applies. And if more than one applies, I would explain why all of them, all of the applicable criteria apply. For example, if you're talking about somebody's specialized skills, this is the only person that's knowledgeable of and knows about our general ledger account, for example, and has the computer skills to handle our personnel database. Have a specific reason why each of these criteria apply and include that in a written signed authorization. That way, if there's ever an audit, and we don't know that this is really the honor system here, so we don't know whether the Department of Labor is going to come back and want to audit this. If there's ever an audit, you've got that documentation in place. And remember, the Department of Labor's first guidance on this small business exemption did talk about the need to keep documentation, although they say they don't want to see it. But I do stress that if you want to claim this exemption, really think through those criteria and how they apply to your specific business. Document it well. Documentation might include not only just your payroll and to show how few employees you have, but also, for example, specific job descriptions if you've got them, or even just a written description of somebody's specialized skills or knowledge that might make them a key employee. Or the number of workers who are able, willing, and qualified to do a certain job when you need them to. So there's the information we've been waiting for on the small business exemption. And again, that's available for for businesses with fewer than 50 employees. And then finally, just a quick update on the Department of Labor's enforcement position. We were excited when, after the Families First Act was enacted, the Department of Labor came out and said they were essentially going to give us a 30-day grace period to comply with the law. And for that first 30-day period, they were going to focus on helping employers comply as opposed to coming after employers with enforcement actions. Well, the Secretary of Labor on March 25th issued a field assistance bulletin limiting that stay of enactment a little bit more narrowly than we thought. We thought it might be a 30-day, and we hoped it might be a 30-day non-enforcement provision that went from 30 days after April 1st, the date on which the act becomes effective. But this new field assistance bulletin has made clear that the Department of Labor considers that temporary stay of enforcement to run from the date of the Family First Act's enactment on March 17th, I believe. And then after April 17th of 2020, this limited stay of enforcement will be lifted. So I wanted to clarify that since that's new information for us. We still got some time to get it right, and good faith efforts are always appreciated, but we don't have quite as much time as we initially thought. And with that, I'd like to turn it over for questions that have been submitted during the program.
Fantastic. Well, Jill, for you and Timothy both, thanks so much for all that great information. So much coming to light today, and so much it's easier to understand with the insights that you've provided. And we'll take just a few minutes to go through some of the most popular questions that came in from those attending today's webinar. We'll start off right here. Does the emergency $10,000 grant program have any effect on eligibility for the PPP?
It does. The emergency grant program interplays really with the PPP loans. An employer that's eligible to apply for both may apply for both and may receive the assistance of both. But if the business receives an advance under the emergency disaster relief grant, and then remember that grant can be for up to $10,000 and it's payable within 3 days after a business applies for the grant, then the amount of loan forgiveness will be reduced by the amount of the advance that was received.
Absolutely understandable there. Is there a date that employers need to bring back any team members that have already been laid off in order to qualify for PPP?
Yes, and that date is June 30th. As long as you bring people back by June 30th, then potentially you're eligible for loan forgiveness under the PPP without reduction.
Good deal. And if we retain 90% of our employees, will the CARES Act loan funds still be forgivable?
In part. If you retain 90% of employees, that still contemplates a 10% reduction in headcount or full-time equivalent employees. And so the amount of loan forgiveness that's available to you will be reduced proportionately based on that formula.
Okay. Our next question was asked several times, and here's a summary of how those were asked. Jill, are the programs that are available, such as PPP, are those inclusive of businesses that have remained open after being deemed essential?
Yes.
So essential
Yes,
status not
they
really
are.
impacting that.
Yes.
Okay. If we plan to take advantage of the Paycheck Protection Program, do we continue to pay our employees like normal, or do we pay them less based on cash flow right now, and then perhaps the difference once the loan comes around? How should that be addressed based on current cash flow of the business?
Well, it's really going to depend on the current cash flow situation of the business. There's no requirement for these forgivable PPP loans for the payroll to be maintained at the same rate. But if you do end up needing to reduce payroll and that reduction is by 25% or more, then the amount of loan forgiveness that you're eligible to receive will be reduced accordingly. Now remember that the loan forgiveness amount only is diminished by a reduction in the number of FTE employees or the reduction of salary and wages by more than 25% compared with February 15th. So if based on the cash flow situation and based on the type of ongoing business operation you have, if you need to reduce wages and you're able to do it by, let's say, 20%, 15%, 10%, even if it's during that period, during which you've applied for the PPP loan, that amount, the smaller reduction, less than 25%, should not impact the loan forgiveness amount. But if you reduce the salary or wages by 25% or more, then the loan forgiveness amount will be reduced accordingly. And excuse me, that's actually by more than 25%. If you reduce the salary and wages by more than 25%, then the loan forgiveness amount will be reduced proportionately.
Very easy to understand. That's a great answer. Thank you for that. Now, on the PPP, does the 8-week period have to start by June 30th, end by June 30th? How does that work?
The 8-week period starts on the date of loan origination. And these loans people can apply for these loans right up till June 30th under the provisions of the CARES Act. And so there's a little bit of question. It's possible that if somebody applies for a loan and the loan originates as early as May 1st, that entire 8-week period might take place before June 30th. But there is the potential for somebody to get one of these loans, one of these PPP loans later in that period. And if you got one, let's say the loan originated on June 28th, your 8 weeks would run beginning on that date, June 28th. And so it would go on beyond the June 30th mark. Okay,
great answer. Now, for many of the dealers that participated today, they do pay their employees on commission. So the question is, while under the PPP program and mindful that they need to avoid a reduction in compensation of more than 25%, would they look at more of a monthly average for the previous period before this event, or how might they go about doing that with commissioned employees?
I would look for further guidance on this, but my initial take, based on the information we now have on the CARES Act, would be that we need to continue to pay them as we normally pay them when the commissions are due. And there might very well be a reduction as we're seeing, business downturns relating to the pandemic. And that might end up decreasing the amount of payroll, either during the period that's used to determine the total allowable amount of a PPP loan, or during the 8-week period during which our payroll expenses are potentially forgivable. But I do not believe that the CARES Act allows us the flexibility of looking back at averages for commission-paid employees. That said, this is one area that I would be interested in receiving further guidance on from the Department of Labor, and hopefully we'll receive that, or from the SBA.
Absolutely. We'll all be keeping our eyes out for that. Now, when it comes to loan forgiveness within this program, would a dealer need to make sure they hire the same folks who were in those positions before, if they've done furloughs or had terminations, or is this going to be based on having just the same number of employees to get the maximum forgiveness?
The statute is written in terms of rehire and reinstatement. So without looking at the statutory language right now, I believe that it would need to be a rehire or reinstatement of employees who were let go during the period that we're looking at here. But that's something to double check me on in the statutory language, and also something to look for further guidance on coming out of our agencies.
Absolutely. Now, if a business is still operating profitably, can they still get an SBA loan and get it forgiven?
If a business is still operating properly, I don't believe that they're going to be able to get a PPP loan. Remember that in order to get a PPP loan, a borrower has to certify under oath that the loan request is necessary to support ongoing operations due to the uncertainty of current economic conditions. And if you're still cooking along, you've got a profitable business, and you're not seeing a significant downturn or any downturn, or maybe you're even seeing an upturn during this pandemic, then I don't believe you'd be able to certify that the loan is necessary for the reasons that are required under the statute.
Fantastic. Now, this question was asked several times with a couple dates right here in this range, but it says due to normal staffing needs, we hired new team members on March 15th. Can that salary still be applied under PPP?
Yes, that salary can still be applied, I believe, and let me look back at the formula. That salary can still be applied when determining the average. Bear with me 1 second. I want to be sure I have the formula and the dates in front of me so I get it right.
Certainly.
That salary should still be included in the total monthly payroll costs, the average total monthly payroll cost for the 1 year period before loan origination. So your loan's going to originate at some point before June 30th, and that somebody who's been hired in March would have their salary included in at least the last few months of that period for purposes of determining the average monthly amount. And then, you would multiply that average monthly payroll cost by 2.5 to get your total loan amount.
Very well said and very easy to understand there. Now, in a related question that was asked numerous times, for those payroll numbers, is that going to be based on the total dollars in payroll or the number of employees or both?
Different answers for different reasons. If you're looking at the total amount of the loan, we're looking at the total dollars of payroll in order to determine payroll costs for purposes of determining how much a business is eligible to apply for under these PPP loan programs. But if we're looking at the potential reduction in forgivable loans, whether the loan otherwise forgivable amount of the loan should be reduced because you've had a reduction in either full-time equivalent employees or overall payroll costs, then it could be either number of employees or amount of payroll.
So definitely need to be mindful of both of those as we sort through this. Now, another question that came in, a couple different variations here, but very pointed question. If an employee quits and we have to pay out their accrued vacation time, are those wages eligible under PPP?
Yes. The accrued vacation time that's paid upon separation would be treated as a part of the payroll cost for determining the overall amount of the loan. And they also, if the employee quit during the 8-week period that we're measuring our payroll costs for purposes of determining the amount of loan forgiveness, they would count toward that as well.
Okay, and Jill, our final question today, this was also asked several times, several different ways of framing the question. This one's very easy to understand. If all layoffs are completed by 4/26 and everyone is reinstated by the end of the 8-week forgiveness period, do we still get full forgiveness even though over the 8 weeks we employed fewer people?
And I want to, there's two answers here. First of all, the dates we're looking at are April 26th and June 30th. In order to avoid any impact on our forgivable loan amount, what we need to do is basically if we let anybody go before April 26th, we need to make sure that we bring them back by June 30th. And if we bring them back and we reinstate them at the same salary, same wages, then there should be no impact on the forgivable loan amount. The 8 weeks does come into play, though, because, you know, it's also potentially beneficial to bring people back at the time of the loan origination or shortly thereafter. And in that way, if you need them as employees, if you need to bring the staff back. And that way, you've increased your payroll costs during the 8-week period that's measured for purposes of determining the total amount of the loan that's going to be forgiven. But the big number is the big date here is June 30th. We need to, in order to maximize loan forgiveness and avoid any reduction in our loan forgiveness amount, any temporary reductions in the workforce or salary and wages that's 25% or more, or more than 25% should be conducted by April 26th, and we need to eliminate those reductions by June 30th. And if we do that, the loan forgiveness amount will not be reduced.
That is a fantastic answer, easy to understand and easy for us to follow. Well, on behalf of everyone who attended today's call and on behalf of our team here at Nationwide, we'd like to thank you and Timothy both for lending your expertise, your time, and your effort put into this presentation and sharing this with us. We certainly do look forward to being able to connect with you again as we continue to go through this and as things continue to change. For those who attended the webinar today, again, we're sorry about the technical difficulties that were encountered in the center, but we are happy to bring you this by video and for your reference. We'll also be distributing the slides from today's presentation as well. If you have any questions, feel free to send those to us. You can send them globally to the entire team at ask@nationwidegroup.org. You can also reach out to any member of the Nationwide team, and we're very happy to help. Again, a big thanks to our partners at Kistanji for coming on with us, sharing their expertise and insights, and we look forward to seeing you again. Have a great day and be well.